Hello, and welcome back to my channel, The Midlands Investor, your one-stop shop for all things investing and personal finance. Today, I'm going to summarise the 5 key takeaways from the widely acclaimed personal investing book, The Intelligent Investor by Benjamin Graham. The Intelligent Investor was first published in 1949 and provides strategies to the average investor on how to successfully use value investing in the stock market to generate material wealth. It has widely been recognised as one of the most influential personal finance books of the 20th century. The book is often cited by Warren Buffett, the great American business investor and CEO of Berkshire Hathaway, as the best finance book ever written, and is often referenced by him in his public conversations. For those that are new to the world of investing, value investing is a strategy that looks to target stocks of companies that are currently undervalued by the market, but yet have the capability as businesses to perform well in the long run. Whilst you may think that investing in stocks and shares is overwhelmingly volatile and that you need to buy and sell constantly in order to generate a return, value investing is actually the polar opposite of this. The theory sitting behind value investing being that if you buy at a fair price and are able to control your emotions through the natural market price movements up and down, then the long-term hold play is the best play. This is based upon the theory that the market typically overreacts to price changes in the short term, for example, a recent press announcement or the latest release of financial results, for example, without taking into account a company's fundamental ability to generate long-term growth. As a result, Benjamin Graham believes that investor focus should be directed towards those businesses with steady, long-term growth potential, rather than the short-term boom or bust players typically associated with growth investing. He states that what is needed when deciding whether to invest in stocks is a sound intellectual framework for assessment with the ability to control emotional responses from ruining your long-term investment goals. So, now I've shared a brief background into the book and the theory that underpins it, let's jump into the top 5 must-know key takeaways from The Intelligent Investor. Takeaway number 1. Meet Mr. Market. Imagine you buy a stock for £100 today, and every day from this day forward, a guy named Mr. Market turns up at your home, knocks on your door, and offers to buy your share or sell you another one at a specified price. The price on offer could be higher than the £100 you paid, say £120, or lower than the £100 you paid, say £80. For all intents and purposes, his opinion on how much your share is worth is simply that, an opinion, and in summary, could be considered to be complete rubbish. Graham explains that actually, your stock that you just purchased is an ownership interest in a business, not just a ticker symbol and an associated price set by Mr. Market. He goes on to explain that Mr. Market will frequently over or underprice your stock, and just because he offers you a certain price does not mean that you have to buy or that you have to sell. And just because the market prices it in a certain way, that does not mean that the intrinsic value of the business changes. Graham concludes that you should only invest in a stock if you are willing to hold it with a cool, rational head over the medium to long term, say 5 to 10 year period. This way, you avoid being influenced into buying or selling by market price fluctuations at what may not be a fair price at the time. Lastly, in the modern world we live in now with phones, laptops, tablets, and constant notification interruptions, the market is constantly inundated with new information that may then influence your buy, hold, or sell decisions. Remember, however, Graham's point is this: just because Mr. Market shows up at your house on a daily basis with news updates and price fluctuations, if he doesn't present you with a good offer to buy or a good offer to sell, then you should simply thank him, ignore him, and get on with your day. Takeaway number 2. How to invest as a defensive investor. Graham explains that there are 2 types of investors in this world: the defensive or passive investor, and the enterprising or active investor. The defensive approach is most suited to the majority of people in this world, as the time they are willing and able to dedicate to investing research and execution is minimal. Graham explains that the defensive investor simply invests a regular amount into the stock market on a periodic basis, for example, monthly straight after your salary, and simply lets the market do the heavy lifting and work for you in the background whilst you sit back, relax, and wait for your returns. The theory behind this approach is dollar cost averaging, and will mean that sometimes you buy shares when the market is high, and sometimes you buy shares when the market is low. But on average, over the long term, you are buying it at what is defined as a fair share price. Graham then explains that behind each defensive investment strategy, there should be 6 key considerations that should underpin your approach. These include diversification, anywhere between 10 to 30 companies, with no over-reliance on any particular company or sector. Large companies, so those with $100 million of revenue per annum or more. In today's money, that works out at around $700 million. Thirdly, that the business is conservatively financed with their current ratio of 200% or above. And the current ratio is defined as their current assets divided by their current liabilities. Fourthly, dividends. Dividends should be paid for at least the last 20 years. And lastly, the business should be able to demonstrate earnings growth over the last 10-year period. With all that being said, in today's world, over 70 years on from when this book was first published, an alternative approach would be to simply invest in low-cost index funds that automatically spread out your investment over a number of companies and a number of sectors to give the investor an average reward over a long time period. Takeaway number 3, how to invest as an enterprising investor. Graham explains that an enterprising or an active investor is much more demanding, requires a lot more patience, discipline, and time. He also explains that it is a hell of a lot easier to fall foul of price fluctuations from Mr. Market, and that active investors over the past 50 to 100 years have often failed to beat the market over the long term. Graham explains that the market tends to overvalue high-growth businesses with more favourable pricing metrics, for example, Amazon, and undervalue those that may have less favourable metrics. And as a result, as an intelligent investor, you should avoid growth stocks, simply because the investment position is based upon future earnings for growth stocks, which are generally less reliable than current earnings of those slower, steady-state growth companies. Takeaway number 4, the margin of safety. Graham explains that the margin of safety is the difference between the intrinsic value of the stock and the price that we paid. For example, imagine we have paid £100 for a stock, but yet we've calculated that the intrinsic value for this stock is actually £150. The stock is therefore deemed to be undervalued by the market, and hence there is an opportunity to generate value over the longer term for us as investors. In terms of the margin of safety, this stock is £50 in the green. This means that we purchased the stock at a 33% discount to its intrinsic value of the company. This is a crucial theory followed by Warren Buffett over the last 80 years of his investing career. He sticks to 2 key rules. The first rule being, don't lose money. The second rule being, don't forget about the first rule. The margin of safety theory is therefore critical when deciding how much we should be paying for a company's stock. Takeaway number 5, adopt an evidence-based approach to investing. Graham describes investing as evidence-based, and that speculation does not have the same level of scrutiny as it does if you are investing through analysis. If your investment does not meet your target analysis returns, Graham states that you are speculating rather than investing. Interestingly, Graham did not say to never speculate, but recommended allocating no more than 10% of your investment fund to what he calls your mad money account, i.e., your speculation account. This is loosely defined as money that you are prepared to lose should your speculations not materialise. And remember, an intelligent investor will never dump a stock based upon its share price. Instead, they will consider the value of the intrinsic company that sits behind the stock and decide based upon that. So, in summary, the 5 key takeaways from the intelligent investor are: number 1, meet Mr. Market. Do not be swayed by short-term price fluctuations. Focus should be on the intrinsic value of the company first and foremost. Number 2, the defensive investor. This is the most suited investment approach to the majority of people who want to limit their time attributed to investing. Invest on a regular basis to benefit from dollar cost averaging and to ensure a fair cost price is obtained over the long-term period. Number 3, the enterprising or active investor. Being an enterprise is much demanding, requires a lot more patience and discipline, as well as time researching stocks. Graham explains that you may want to form part of your portfolio from an active perspective, but not all. Number 4, the margin of safety. This is the difference between the intrinsic value of the stock and the price we paid for it. This is critical to protect yourself as an investor during market downturns. And number 5, adopt an evidence-based approach to investing. Evidence-based is greater than speculation. Rely on the facts and figures presented to you in the financial statements rather than market hearsay and speculation. And that's it. Thank you for watching. Don't forget to like and subscribe to my channel, and I look forward to seeing you all again.